Managing expectations. And this is something, as I said off the top of the show, something I try to do on a regular basis. If an investor has an expectation of making a certain amount of money or having certain types of protections regarding their portfolios, and your portfolio is designed not to earn you a certain growth rate or not to have those protections, then there is I guess, miscommunication between the advisor and what the individual investor is anticipating from their portfolio, the outcome or the growth rate, or what their goals are, or what their goals are looking, or what they're looking to obtain from their portfolio. And managing expectations is extremely important in that respect, that you talk to the individual investor, that I talk to the individual investor to make sure that we're on the same page. And that is what I spend much of my time doing, talking to individual investors, making sure that they have the right expectation for the portfolio that I have designed for them. And that is really, or shouldn't be any different than any investment advisor. But managing expectations even goes further than that. Our first chart here that we can put up is the business cycle. And I've shown this chart or this picture before. It's been a while since I've shown it. And it talks about expansion. Then you go through a peak, and then you have depression and trough and recovery, back to peak, back to recession. And it's this nice smooth curve. Well, I can tell you first, the economic cycle definitely does not look like that. You never have an exact curve, an exact smooth curve. You'll have many ups and downs within the peak, within the expansionary part of the cycle, within the trough part of the cycle. So it doesn't really look like that. But it definitely, the areas that are highlighted, peak, expansion, recession, recovery, those are definitely important areas or headlines to note. Now, I'm not here to say that, well, where we're at today is a peak and we should be mindful that we're going into a recession. We could stay at these peak levels, and really that's where we're at, right? Where markets are at high points right now. We could possibly stay in that peak range for quite some time, taking it gradually, taking it slowly, allowing for the other 493 stocks, as I just said in the previous segment, to catch up and get involved in the growth, the coming out of where we've seen with the tech stocks and how much they've dominated. It's time to see some of the other sectors get involved with the cycle here. And investors, I think, as I said in the previous segment, I think you can be an investor today, even though we might be at a temporary peak and maybe make new highs on a regular basis, which we've been doing for the first, let's call it 6 out of the first 7 months of the year, 5 of the first 6 months of the year. I think that the cycle of emotions, as we call them, is valid. But I think that based on what has been happening, we could stay in the range we're in right now for still quite some time. But we could hit a bit of a correction maybe in the coming months. And that's what I wanted to talk about as well. The fact that you need to have the right expectation. And I have another chart of the S&P 500, which we can throw up on our screen here. And I wanted to show this because it's important. The last time we saw a pullback in the markets was April. And that was about 5 to 7% pullback. Let's call it 5 to 10%. Keep it a good number. Time before that we saw markets at low points or pulling back was last October. So really, since last October, if you take away that one and started as of November 1st, we've only seen one correction. But we know corrections are healthy, and we see corrections all the time. I had an email from a client recently talking about how maybe we should sell at some point at the end of July and kind of keep some money in cash to wait for this correction, to then buy back in and then ride the wave higher at the end of the year. In theory, maybe that works, but you never know. I've seen markets go up in September and down in November. I've seen markets go down in July and higher in October. It is not an exact science. Historically, we can look at numbers, we can look at averages, but overall, we don't ever know, and it's very hard to predict what the market's going to do, what investors are going to focus on, how high the market can go before we see that correction. So having the right expectations, in my opinion, are very simple. You want to, if you have a growth goal or your goals for your portfolio are growth oriented, you want to stay in growth, but you want to continue to move money around, maybe trim some of the profits, maybe buy some undervalued names, continue to move money around within the portfolio itself, because you never know when the next pullback in the market is going to take place. It is healthy that we have these pullbacks. And as long as you have the right expectation and expect to see pullbacks and understand that they are healthy, I think you're going to be just fine. And I think that owning a good quality portfolio, owning good quality names, names that hopefully even pay you some good dividends, that has always been the recipe for success. And even when we're expecting at some point a correction or a pullback in the market to happen, I just don't think you go out and panic and sell and try and get ahead of it, because you just never know when that is going to happen.